welcome back. We are at Chayos in conversation with Mr. A Balasubramanian of Birla Sun Life Asset Management Company. So, sir, you've explained to us the importance of, putting more in mutual funds. Now, let's start talking funds. And since you're saying you're expecting a lot of this demonetization cash to start flowing into fixed income, the question is, what sort of funds do you get in? Because, it's a confusing world. The accrual strategy, the duration strategy, liquid funds, medium-term funds, long-term bond funds. So, it's pretty baffling for a retail investor.
Yeah, that's true. I think the first and foremost on fixed income is what is the equivalent of your money that you are keeping in bank deposits that you are looking at it. Predominantly, most of the Indian investors first and actually go and park their money in the savings account. So, what is the mutual fund schemes is equivalent to the savings account, which we call it the liquid fund or money market funds. Therefore, the first and foremost, the motive of the investor should be to choose the product which has got the least risk and also has got a predictable return. At the same time, it provides the liquidity at any point of time which they can withdraw actually. So, having come into the liquid fund, then you actually then as an investor, what you do is go and look for 1 year deposits. So, though most of the people actually think that I have to put money in deposits, he either chooses for 1 year deposits or he goes for 3 year deposits. Very rarely people go actually for 5 year or 10 year deposits.
That's right.
Therefore, all such investors, I would assume, given the fact, they choose a product within the fixed deposit segment of 1 and 3 year bucket. The mutual funds do offer actually the product in that segment of the maturities, which is called actually the ultra short term fund or a short term fund or maybe even short term opportunities fund. And anything with this word which is used as the short term is essentially means they all invest in actually 1 to 3 year kind of bucket. Okay. Therefore, the investors who are actually predominantly looking for deposits and a 1 to 3 year bucket should logically speaking come into this segment.
So, what sort of securities would these funds be investing? Is it largely government securities or will it also involve certain high yielding paper, but then that paper will also come with certain credit risks, right?
Correct. I think predominantly these funds as per the stated offer of one objective, the investment actually either in AAA bonds or maybe a AA plus kind of bonds, which are relatively, you can say, safer, which are relatively better higher credit quality, and also invest in government of India bond as well. At the same time, mutual funds in the last few years also have addressed the needs of the investors who predominantly go and invest in fixed deposit of companies and putting actually putting the money for 5 years and 7 years kind of things, which is predominantly, you can say, are in the rating bucket of say A and A plus kind of things. And therefore, the mutual funds actually to address the needs of those investors have also introduced credit fund, which in our case we call it a medium term plan, which is predominantly actually using the ability of the portfolio manager to identify companies in which we can make investment, which actually are well researched, but relatively not a high quality companies, but relatively actually a and A plus kind of rated company, which call it where the credit risk is very high. But given the fact that we actually invest in those investments only on the basis of secured in nature, it also provides actually longer term safety.
Okay.
And such kind of investments can also provide relatively better return to the investors as long as they come actually for 3 to 5 years kind of investment.
Okay.
Last, of course, the opportunity also provides. See, on the interest rate, there are 2 things you have to keep in mind. In a falling interest rate scenario, assuming you have made investment in the past, it gives you a capital gain. So, in a falling interest rate scenario, it actually inversely correlated the bond price and to the bond yield. So, that's the way one has to look at it. Therefore, in a falling interest rate scenario, a stable interest rate scenario, there is a component which is called an accrual, which if I invest in actually a 9% bond as a mutual fund, that NAV is calculated on the basis of the 9% which I get accrued in my portfolio. If the interest rate falls, bond price
will go up.
If the interest rates go up, the bond price comes down. This is actually the function of daily market scenarios. So, the fund call which is called dynamic bond fund, invest in actually all kind of securities and using the ability of the portfolio manager and take interest rate call.
So let's now break this down in terms of different types of investors.
Yes.
Let's say I'll give you 2 or 3 different examples. There is someone like myself. Okay, now we're asking Mr. Balasubramanian to wear the advisor's hat for the sake of the money viewers. So let's say there is someone who's in their early 30s is not completely averse to taking maybe a little bit of risk, is looking for slightly high yield. So there's this one particular type of investor. There can be another investor who's approaching retirement. So for him or her, capital protection is pretty important. And these are 2 different classes of investors. They're both looking for fixed income options.
Correct.
What sort of funds within, let's say, the Birla Sun Life universe would you advise?
Conservative investors or maybe investors who are actually aged, who are looking for a retirement solution, we can choose a product within the mutual fund space ranging from short-term debt fund to the medium-term fund and dynamic management.
Okay.
At the same time, somebody who actually is young at the age of 30.
So before we come to the 30-year-old, for the slightly older variety and conservative variety of investors, the funds that you mentioned,
Yes.
what sort of returns can they expect, assuming indexation benefit, assuming they're at least going to stay invested for 3 years? What should their return expectation be?
You ought to just go by the thumb rule. The thumb rule that generally is applied in the case of fixed income, setting the expectation on the return, is one, the RBI repo rate. RBI repo rate is today is about 6.25.
Right.
And in general, the RBI repo rate plus about 1.5 to 2% kind of return that one should expect. Second is other way to actually measure. If the bank fixed deposit rates is say about 7%, the mutual fund in general over a long period of time try and generate about 1%, 2% over and above the bank fixed deposit rate.
Okay.
At the same time, we also should not build an expectation that it can give a substantially higher return than the fixed deposit what you earn. But one simple reason, higher the return on the mutual fund portfolio, especially on a credit side portfolio, you need to also understand the fact that there is an element of credit risk as well.
Okay.
Therefore, as a money manager, when you actually offer a fixed income product, you also give some element of safety by investing in only in those securities which are relatively safer, which are more AAA, AA kind of nature, and including government securities, all combination put together, it provides a safety element as well.
So that's about the conservative fixed income investor. Now let's
Yes.
talk about the slightly aggressive person, maybe a little younger, not averse to risk. What sort of funds should he or she go for?
Within the fixed income space are the monthly income schemes. The monthly income schemes, though it's called the monthly income schemes, it need not be necessarily have a monthly income going out to the investors. They can of course choose a growth plan.
Yeah.
But the advantage of monthly income schemes is about 85% of the money is invested in fixed income securities, which essentially mean that those investments continues to earn certain interest component of the portfolio, plus the marginal capital gain on capital that comes in. At the same time, the 15% of the portfolio invested in equity, which predominantly gives a alpha over the fixed income space over longer term. Therefore, anybody who is conservative but wants to stay only in the fixed income aggressive, but wants to stay invested only in the fixed income space, but at the age of say 30 years, he is looking at the longer term investing, and they can also expect a stable return expectations on such kind of schemes, which is a MIP scheme, which we call it as a hybrid funds, but in the conservative category.
All right, so those are some ideas on the fixed income side. We're going to take a very quick break. And when we come back, it's time to talk equities. Now, what sort of equity funds do you need to load up on? And the usual questions. If you've got some capital on the side, SIPs versus lump sum. And of course, digital payments. How are they likely to change the way you're investing in your mutual fund? We'll discuss that after the break.